Welcome, everyone. Thank you very much for coming. And I would like to thank everyone who's watching us via the web and fintech. And I would like to welcome our international investors who are now following us via the web. Now we're celebrating the 4th edition of the Magallanes Investor Day. 2009 is going to be our 5th year of sailing. And now we're getting near to our minimum recommended horizon, at least 5 and preferably 7. You know that value investment time is on our side. The yields, thanks to the compound interest multipliers, the longer the time frame, the better. And these have obviously been a few difficult years along the way. 2008 has been the first year. There's been a few drops. We had suffered a lot, but there'll be more years like 2018 because obviously if you're on the stock exchange, you know that you have to cope with volatility. And if we try to prevent it, we'll be losing opportunities. And as in the Magallanes journals that I love, they say, there are no roses without thorns. So what do we do in these difficult years? Well, we work even harder to what we dedicate all our time and passion to, which are you, investors, customers, and our portfolios and the companies. Now, let me just talk first of all a little about the investors. Thank you. Thank you very much. You are our raison d'etre, and we don't forget you. We try to respond to all your trust, your infinite patience, and managing your money together with ours in the best possible way we know. And also, we want to be transparent and close at hand. Years like last year, we have to be even more so in the year 2018. You haven't just maintained the trust in us, but you've also increased this, and we've got new investors, specifically 420 million of more money. And so now we've got almost 19,000 clients. So thank you all very much. They've been very difficult years with redemptions, can make things more difficult. But I really think that's what makes a difference between how we work. We have a customer base that is very solid. We have a customer base that's very sound. And we are all aligned. We share the trust. And we share our time horizon for investments. And around 60% of our investors are family offices. There's a lot of entrepreneurs. 25% are institutional investors. And 15% are just the small investors, because Magallanes started with the idea not to have a minimum amount. Any investor can come along with a minimum stake, 500. We didn't have a specific amount. So I think just over half of the people are Spanish and the rest are in the Luxembourg funds, where the majority are international investors. We're very satisfied with our success in Spain and also very satisfied the fact that there are so many young people that we have. At Magallanes, we give access to a cheaper class for younger people to promote savings among the young people and with periodical contributions. And the other things that we have been doing over this time is looking at our portfolio, studying companies. You know that Magallanes is a niche fund management company. Our competence circle, we study companies in Europe and ones that will then either go into the Europe fund or to the microcap fund or to the Iberian fund. But everything starts and ends with the companies themselves. They are the be-all and the end-all. Today, we have with us a lot of the products that our companies produce. They're at the back of the room, which will allow you to get to know them better. And so we are a fund of companies that are listed on the stock exchanges. Today, we're lucky enough to have with us one of the executive president of Gestam, Mr. Francisco Rivera. As you know, we like to invest as if we were owners, and it's a true honor to have one of them with us today. We admire the figure of entrepreneurs, and especially that of Francisco. So this is how we can really bring you closer to our culture. This dedication to clients and to portfolios is done thanks to our team of 15 people at Magallanes. I would like to thank all of you for your dedication, your commitment, for your passion, and your strive for improvement. and to all collaborators who we delegate all our other functionaries, like the Santander, CASA, Pictet, Phenometrics, their different platforms, All Funds, Inverses, Tresses, Egeria, and many others. So I'd like to thank all of them, and especially the advisory board, who have been with us since our very beginning. Today, Iván and the rest of the team are going to talk about the portfolio, and they're going to answer the questions. And also what we've done, we have now got a new app so that you can put all your questions up there, and you can vote for the most interesting questions. So that obviously the most popular are covered. And you can also do this in a traditional way with the help of the Capaces hostesses. Once again, we thank the Capaces Foundation, because it reminds companies that we have to be involved to use people and employ people who've got certain disabilities. Capaces is one of the 4 foundations that when someone invests in one of our pension plans, we provide money. The other one is Valia, Proyecto Hombre, and also one called Mi Grano de Arena. Anyway, before I give the floor to Iván, I would just like to go through a couple of milestones in last year in Magallanes. One of them is that in 2018, it was the total or partial closings of some of our funds. We have fulfilled our commitment to control the size so that we damage the returns. We are pioneers in Spain because Spanish regulation doesn't allow you to close funds. In Luxembourg, where it is allowed, as I said, in Luxembourg, you can close the funds. What we did was that we closed it to new investments. In the Spanish funds, what we've achieved is that as of certain volumes, then we don't accept more investments. So we've absolutely kept to our commitment, and we've said that, big sizes can't affect the returns. And so this is what we have done. In the case of the microcaps, around 100 million, and in the Iberian fund, around 500 million. When the equity is under those levels, obviously they're opened automatically. And with the European fund, we'll do the same once it receives 2.5 billion, and at the moment, the actual amount we have is 2 billion. So as some of the funds are being closed, some people say to us, what new fund are you going to have to continue to grow? And I'm going to answer this very sincerely. Probably none at all, because I don't really think you need to launch a fund just to continue to grow or to get new investors. No, and we really don't think that any fund managers have to cover all types of assets or have a trendy fund. A fund has to be one that is unique, that is a true opportunity for all of us, and you need to have a perfect team to make sure they do excellent work. It's not easy. We don't want to be a fund supermarket, and there are very few fund managers that are good at absolutely everything. And so we want to be true to the way we manage our assets. And so therefore, you need very specialized managers, and increasingly more active management doesn't seem to be very trendy these days. People tend to be more passive one. This is why a lot of investors are disappointed. They're paying commissions, but they don't seem to be doing better than what the index is doing. And so what we're doing at Magallanes is between 15 or 20% of our funds is done with our own money, that of the team, the actual founders of the company. And obviously, we're totally aligned with our investors. And so we only invest in funds that we believe in. Having said that, we have launched a new fund, which is called Magallanes Impacto. And it took us 2 years to launch this fund. It's been very difficult. It's a true pioneer because it's the first impact fund that has liquidity. I can't see Mónica de Clo and Emilio Salvador for their tenacity and their patience to actually get this off the ground. And I said this Impacted Fund is a hedge fund which has got social and economic returns. They invest in microfinance projects that offer microfinance to people, normally women in developing countries, so that they can say goodbye to poverty. And we want to do this without depending on philanthropy. So this fund is non-profit fund for Magallanes, but it is profitable for our investors. And in addition to that, it has an impact. We want it to have a measurable social impact. And if it's not fulfilled, then we will return the commissions. Our advisor is Gawa Capital, which is a leading company in this type of assets. And we love these assets because has no correlation to the markets. It means that we can diversify. It has to offer returns. And we launched it, I think, in October. We've got around 20 million in equity at the moment. Unfortunately, we can only offer it to professional investors. That's all that we've been allowed, with minimum investments of 100,000 euros. We have quarterly subscriptions and 6-month redemptions, and we're currently building up the portfolio. And during this period, as I say, we have reduced the management commission to provide returns. So what we want to specify that this isn't it isn't an ESG fund. Everyone's talking about this ESG, and it's related to environment, social, and good governance. So what is Magallanes with respect to that? Well, at Magallanes, we are signers of the Principles for Responsible Investment in the United Nations. We've been that for a few years. And also, we believe, and I think I said this last year, that companies, in the development of their activities, they can have both positive and negative impacts on the environment and the society. And this has to be controlled and managed to make sure that the positive things are better and to reduce the negative things. If you don't take into account, environmental, social, or corporate governance rate, this could affect your profits, sustainability, your fact that you're competitive. And so at Magallanes, when we analyze the company, we obviously, all these risks we do take into account. But what we don't do is to choose a company in line with the fact that whether they have certain impact, because what we don't do, we do not veto different sectors because they have such and such consequences. The only fund that has a purpose of having a measurable social impact is the impact one. In our pension funds, even though we have this philanthropic donation, it isn't one of these funds. In 2018, we have continued to support digitalization, and I'm saying that today because I know the web sometimes wasn't working as it should have been working. I apologize for that. We were the first fund management company that allowed for 100% digital registration, so nobody had to step foot in any of our office, and you didn't need to print any papers. 80%, as we say, some of our customers can go into our web, into the Magallanes inside, and we also enabled that for pension plans and also for double ownership. We know that there's room for improvement, and the user experience, if people explain what their user experience is, this will help us to improve. 2018 was a year for the MIFID, which is a Market in Financial Instruments Directive to protect customers. It was a year, as we say, this is part of our DNA. And as we say, last year was the first year where the Magallanes management company was responsible for all the analysis of the funds. They just covered the brokerage, which meant that the expenses were lower, which means that our customers got higher returns. In 2018, we are also committed with our vocation. We've participated at universities. We've been trying to promote young people saving. And we have an application called CoinScrap. And what it does is to help people to save and to invest by rounding out the expenses. We've also been distributing books, and we've been collaborating with different schools. I can see the Value School, which is here today. And I would like to thank Value School and congratulate them for all their hard work and what they're doing. And finally, in 2018, we have received several prizes, which is very good. We want to continue along these lines. But as I say, we don't want this to go to our heads. And so therefore, I always repeat Gandhi's words that I absolutely love, which says, God, if you don't give me success, please don't take away my humility. So therefore, I would also like to apologize for any errors we may have made. And if you have been not happy with everything we've done, but as we say, we're very grateful for your feedback, your criticism, and any suggestions. And before I give the floor to Iván, now let's give you a video showing impact. It's called Magallanes Impacto. Anyway, so I will leave you here. Thank you very much, and I hope you enjoy your session. Well, the challenges that humanity has to face next few years is fulfilling the Sustainable Development Goals for the United Nations. These SDGs present a world without poverty. They present a sustainable world, a healthy world with health and education for everyone. It's a dream, but what you need to get $2.5 billion in investment, philanthropy, and public money isn't enough. So what we need is to get private capital. So to get this private capital, what we need to do is to solve social problems in a sustainable manner and also have competitive finance for this. With the SDG 1, which is eradicating poverty, there are three things. One, we need to offer opportunities, financial sustainable ones to the poor people, and also we want to reduce vulnerability. Microfinances fulfills these two challenges. So through finances or microfinance to poor people, they can then set up their own jobs and they can have recurrent income. And also by saving and some sort of insurance, they are able to reduce all the uncertainty that these people have in their daily lives. I'm Adriana Martinez Garcia, and I'm in the Solchimiche delegation. I have a small company which is called Juice Therapy, and it's something marvelous that I do. And I'm able to maintain my business, and I can continue to work. We don't have the culture to look after money. And I'm very thankful to CAME because they've taught me how to work, how to save, and they've given me lots of information. And they've encouraged us to certain courses so we can learn and share ideas with other women so that we can learn to be savers. So this is my little mini company. Well, I had fields and we had lots of raspberry bushes. But then we thought, my wife and I said, well, we need to do something with this. But we didn't have enough money to do what we wanted to do with. So I said, well, I'm going to go and get a loan. And so he said, okay, why? Let's see. We got 100 and, I started this with 100,000 pesos. And we said, we haven't got a big luxuries, but we have all what we want. We could buy things that we never even dreamt about before. And now, because we have this raspberry business, and then afterwards you realize that we even bought a chair. Because after we used to sit on the floor on a tree trunk. Thanks to what? Well, thanks to these raspberry bushes that started to grow. I like to thank God for providing us with raspberry bushes. So Magallanes' impact is different because apart from measuring the social impact, we also try to manage the impact. We try to maximize the impact that this microfinance can have on the poor people throughout the investment by providing advice to the management team of how they can do more so that the beneficiaries, our customers, can really leave poverty behind. I would like to thank all the investors who have trusted us in Magallanes Investors. Thank you very much.
Thank you very much, and good afternoon to all of you. Thanks for coming. And I'm totally in agreement with everything that Blanca said at the very beginning. And I'd just like to emphasize as well our gratitude to all our investors, particularly those who have stuck with us, and the new ones that came to us in a complex year, which of course was last year. We continue to manage your portfolios with a lot of enthusiasm, as I say. We're not going to let you down. Isn't it, as I say, weeks? There have been weeks and quarters and 6-monthly periods, as I say, that have been pretty low. But we've been working along all of this. And I'm going to talk like we usually do at these annual conferences and sort of account for the different funds that we have and what we have done. And it's the 5th year, as I say, and we can talk about different concepts on medium and long-term basis. Makes sense to talk about returns from our funds, and there's temporary periods, and then we can talk about how the stock exchange is behaving. This is something new this year, and then we'll go into greater depth, as I say, with regard to the investment funds, the philosophy behind the process, and the main characteristics of these. And we will finish with this small outline of the micro cap funds, because we have received a lot of questions posed by you people with regard to these micro caps. And then, of course, we can have a Q&A session. Okay, let's talk about the returns now, or the yields. And it's, you are all aware of them. And I would just like to tell you from the very beginning, well, this is the Magallanes Fund, the Iberian equity from the beginning until, well, April. We have, if we were to take a look at the reference index, which is very significant, 45, compared to absolutely nothing, the national market, the Iberian, Portugal, and Spain market, 9.2% compound compared to that nothing, as we say, of the Iberian market. And to talk about the pure returns, which we're all aware of, and we have to be satisfied. And the message is that when we have to conserve the capital and make it grow, and make it, as I say, hold on to the capital and make it grow. That is our motto. And you can see that we're fulfilling one of our basic premises. As you can see, well, last year was a complicated year. In Spain, there's not many similar ones from the point of view of rating, from the actual rating, the 5 stars, etc. Well, the European Fund, likewise, which 38% of an index, which is 19. In other words, we doubled the alternative, which is to invest in the stock exchange market, the European stock exchange. And this is 8% on a compound on an annual base. As you know, last year was a very complicated year for the European Fund. And during the Q&A session, we can talk about the holdings of some of the sectors and the different industries. And we can, as I say, give you some more information there. But on a long-term basis, we've been able to recover these losses, and we have returns, as you can see, close to 20%. The micro caps that we'll talk about in greater detail, as I would say, return is important, obviously. It's not what's relevant here, because it's only 2 years old. But what is important is to understand in greater depth what's within this fund. In the last 2 years, the return is negative. This is not very satisfactory, obviously, but it's a product, to be said on former occasions, and I repeat it now, once again, if the time horizon for us and what is recommendable is 5 years, well, 7 years, and of course has to be 7 years because of the nature of the companies in the portfolio. What's recommendable is 7 years, as I say, and what is desirable would be 10. And that's how we should be measuring the returns of these type of funds. Well, the first 2 years, as I say, is what you can see here, which is negative. The pension plan, well, what we're trying to do is replicate the portfolio of the European Fund. It's not the same vehicle. These are very different, the investment and the pensions, so they can't be exactly the same. They have different inflows and a different cost structure, but the portfolio, in essence, is the same. And this is something new that we have introduced, as I say, and something disruptive at the same time. We've thought about last year, for example, and within our, how can I call it, vocation to teach, if you like, a genuine one at that, just to explain the financial market and how it behaves. Well, we think about the stock exchange, and when we think about the stock exchange, it has to be a long-term investment, and we have to be patient, right? But we don't stop to think and to reason. What is long-term, and why is it necessary for this to be long-term? And that's what we're trying to explain here today with what we are calling the anatomy of the stock exchange. I don't know if that's the best way of calling it, but we want to break it down and see when there's a terrific drop and what happens on a long-term basis, and see exactly what long-term basis. Why do we say 5 years, 7 years, and why don't we say 3 or 1 year, for example? So we have analyzed, as I say, the historical background of the exchange, and seen, I'm not saying if you have to be with one manager or another, but a genuine interest we have is, as I say, I don't know, well, as I say, we want to explain, at least if we're not teaching, at least we're explaining things. And I'm not saying one strategy is better than the others. This is ours, and this is long-term Magallanes. To invest in the stock exchanges, as I say, and have transparency is the only asset that generates wealth on a long-term basis. And it's questionable, of course, what is a long-term basis. Because we are investing in the stock exchange with any typology or philosophy or any process other than that of investing on a long-term basis, well, it has had a multiplicating effect. And in 100 years, it has been multiplied by 5,000 times the investment of $1 or €1. And behind that, we have bonds, as we say. We have liquidity, which is almost nothing. It's fruit at the moment. And more than generating wealth, it's the only asset that can actually manufacture it. No, it can multiply your money, in other words. And to do nothing, for example, with the different investments that one can save, that one can achieve. And you can't achieve anything if you don't invest, but of course it costs money. To do nothing costs money. Money just disappears. The purchasing power disappears. $1, €1, any other amount from 100 years back to now is nothing. It's just a fraction. It's time, it's inflation as well. And then to hold on to our capital, we've got to make it grow. And we have to put it to work, in other words. In other words, we have to invest. I'm not talking about if you have to invest with us or with others. No, it's not talking about our strategy. It's just we have to put our money to work to make it grow. And it has to be at the top, which of course means investing in the stock exchange. It's a concept that we're aware of, but I think it's a good idea to remind us of this, particularly when we look back at last year. Investments in stock exchange has to be long-term, and that's all. No, we're going to develop this for you. And I am presenting here this investment opportunity where we begin at 100, ends up at 800. So we're multiplying by 11 times in 32 years, as you can see. And the profile of this actual curve itself is quite attractive, quite suggestive. There are no falls. You can see there are rises. Sometimes it goes up faster than others, and you're earning money. And if we compare with this asset and this other, well, what's normal because of the psychology of the actual investor is to choose the first asset compared to the second, even though we may earn the same amount from it. The returns will be the same. The asset is the same. As I say, these are European stocks. And we've just taken a representative one here, and that's the one that we're going to use for all the different transparencies. It's the Stock Europe 600, the 600 most representative companies in Europe. I'm referring to the European. It's 32 years of history. as you can see from there. And when we talk about the returns, as I say, we look at it on a daily basis or decade by decade, and we take a look at the different extremes. That's the way you have to study things. And this makes me draw a conclusion or gives me food for thought. There is no investment for the sake of investing. What can be good or bad is the actual moment that we decide to invest in. In other words, our time horizon. If our time horizon is daily, well, it's better you do something else. As I say, the returns aren't hours. It should, not even annual, I would say. If our time horizon is on a long-term basis, it begins to make sense. And I think that this chart represents things far better. Here we can see positive returns, probability of earning money. Well, it depends on how you actually measure it, right? If we take a look at it on a daily basis, there's so many probabilities of gaining as losing. I think we're all in agreement there, and that's why, of course, the casino, for example, we are playing on the stock exchange, we play in the casino, right? So as I say, the stock exchange is like a casino, even I don't like it. That would, depending on our time horizon, of course. Then if we take a look at our investments on a monthly basis, well, we'll see that the returns go up to 63. If it's an annual, it's 73. If we take a look at 5 years, as I say, because the time horizons, I should say, we say is, well, at least 5 years, 86%, almost 9 times 10. We're going to have positive returns when we invest. What is the total? 5 years. But if we talk about 7 to 10 years, the probability of not losing money, of having positive returns is 100%. There was no case in 32 years of history in the European Stock Exchange where money has been lost. So this puts into context things, and that's why I say the long-term basis is what is essential. This is the background, and we see this is repeated over and over again in the stock exchange, right? Well, the memory that we have in the financial market is quite outstanding. And then we talk about periods of 5 years, and that's why in micro caps we talk about 7 years. And we would really like to use 10 years because we'll be able to guarantee then positive returns. An example that we wanted to show you, which is closer to those of us who are here in Spain and can be used for any other index. Likewise, the Spanish stock exchange with the IBEX 36, as I say, well, it's showing us not the technological bubble as such. I'm referring here to the IBEX 35 companies, of course, and we see the period that goes from 2007 to 2012 with the recession in Spain and in the peripheral countries as well. And 17,000 points of the IBEX. And we always say we are below, right? 10,000, 11,000, 9,000. We see how we measure things. Well, this is a sort of an alert. Well, within our teaching vocation, we refer to it as that. It's just that we want our investors to know and ask about the vehicles that are there to invest in, and you should do benchmarking. In other words, with an index that reflects the dividends that are paid out, because the index of the IBEX 35 has been one of the greatest dividend bearers. So 35 or 40% of these 16,000 points, it is close to what we call historical maximum figures. This is just an observation that I would like to give you, and it's an index for a market that has suffered an awful lot in the last few years. We carried out this analysis and we're measuring the long-term basis here. If an investor had invested at the worst time in the Spanish stock exchange, I'm not talking about any type of strategy. It was just a UDF, as I say, or an ETF, I should say, and if we take a look at the maximum of 2007, if we're measuring that, just being patient, as I say. It's easy to say this, of course, but you have to suffer and live through it and experiment it. And in these 7 years, the recovery of your investment will take place and has taken place. And I say it's one of the most tangible examples. The time horizon is very important, and this period of 7 years hasn't been randomly chosen. And something else which persuades the investor when he's the first time investing in equities. I talk about the returns with a time horizon of a long-term basis, can think about 9 or 10% returns. And is it sustainable? Well, this is something that's been asked, and we'll talk about that. The average returns, as I say, in the European case, and during these 32 years has been 9.6%, as I say. That's the average return, 9.6%. And each point you can see is that for a natural year, a calendar year, I should say. It's just on one occasion, which was 2015. The return coincided with what the stock exchange should give you an investor for this first time, in other words. With that expectation in 9.6%, 10, 9%, well, it's a really good investment for me. But return on a long-term basis of 9.6 doesn't mean that every year it's going to be 9.6. As I say, your first year can drop by 20%, which happened last year. So you'll have a rejection feeling towards the stock exchange, towards that vehicle. And maybe it's not for you if you can't, stem the tide and hold on and wait, as I say. And that's what I'm trying to transmit to you here. I want to let you know why this happens. And then, of course, there is a recovery. Return is not linear. I don't know how I said I didn't know how to say this. Not to act feeling fear, as I say. But it's logical to feel fear, as I say. It's very difficult not to be in a state of fear when you are investing. But what you have to do is to react. When we feel afraid, it's just something within us, because we are human beings at the end of the day, and that's the way we react. I just want to go right back to 1926, and you see the terrific crash in 1929. As I say, the inflation rates, as I say, the way things have gone. Some have been very positive things, other things have been very negative. And we can see exactly what happens when the market gets ugly, what happens when it drops. And what we have seen clearly here is when the market is ugly, and when we go into a bearish market, and or when the market has a terrific drop, and as I say, when it's bearish, in other words, of drops of more than 20%, in the crash in 1929, you will remember, it was the money almost disappeared, as you know. This strong drops, as I say. Well, last year was considered one. According to this calculation, you can see it 41, and you can see it here, minus 41%. That's 18 months approximately. And what we see then is what happened after that. You can see these terrific drops. If one can stick in there, it's easy to say that, of course, but it's not easy to do it because of the instinct we all have of wanting to earn money. Not only do we recover from the loss, but we do everything to recover it. and we would lose an option of earning money. Many observations that we've seen over the last 100 after big drops. Well, what it did with the multiplication after the drop that came along was by 6, because the market swings an awful lot, as I say. There are markets, as I say, that drop at a terrific speed. If we take a look at December of last year, for example, you'll remember, even though our instinct tells us something different, the most rational decision is that if I'm not purchasing, I must maintain. It's easy to talk after the increase that we've had in the last few months of 20% in the European market. But this is what history tells us. Be careful. Be careful in executing losses in bearish markets, because the first thing you have to do is recover. I'm not talking about earning. And then we take a look at, as I say, what's expensive and what's cheap. Well, the market has improved, and of course there was a drop last year, as you can see there. And this year, now we're seeing a clear recovery, but not in a symmetric way. There's terrific disparity. We see the all highs. An ultra simplification I give you there. If we were to divide this, what we call what is expensive and what is cheap, they talk about growth and value as cheap, if you like, and value as expensive. The higher the amounts on this chart, well, the value strategy is, which is, of course, what we do it better. But you see, when the strategy that we do not apply, just to give you an analog, on the side where we are fishing, if you like, because there are fish, because we're able to find fish in the sea, but there aren't too many fishermen. But on the other side, there are not too many fish, but there are a lot of fishermen. So, of course, the price is very, very high then. So the strategy now, the growth, the pricier one, is where lots of competitors. So the valuation of these holdings, which can be technology and can be luxury companies, luxury products companies. And I'm just anticipating the situation here. But these are some of the questions that we have got. And as I say, this shouldn't be interpreted as low growth. It means that pricier has to be technology. That does happen in the United States, but in Europe, as I say, we have companies that are pricier and they're not technology. For instance, Hermes, the actual ties, and that's not technology. Well, I'm just trying to show you here that what is cheaper, what is pricier is in a business that has been invented. They don't understand it. They just take a look at holdings that will offer security and will pay what is necessary.
So you can see these reach levels that are really challenging these. So this has now gone to extremes. We have levels that remind me of the previous technological bubble when people talked about a change in paradigm, a new era. Do you remember that? Well, the world is going to become digital. The world is going to be an online world. 1999 to 2000, all companies who used the word internet, online, or .com, they went, because people were really interested, and so the price went up. I don't doubt technology. Technology doesn't exist. Technology has made life easier. But what I do doubt or question is that because of this technology emotion of all these different assets that come, how many companies that are working in those technological worlds actually still exist today? So there was this big technology bubble. So just to end this slide, where are we now? We're at a point, well, it says at the bottom, where what is expensive is becoming more expensive and what is cheap is becoming cheaper. we are continuing on the side where we're looking for the fish, but we don't always have investors that want to accompany us. But history says that sooner or later, when everyone's filled up, when all the fish run out in the one pond, then they will come to our pond and start fishing there. And that's what history has demonstrated. And it's got 50 years of history. And there's different strategies of value. At the end of the day, to buy things cheaply, we can make it sound sophisticated, but when you buy cheaply, it really has to be a smart decision. You have to buy things below their real price. That's not debatable at all. What is debatable is how long you're prepared to wait. And I'm not going to talk about that again because I've already mentioned that quite a lot earlier. Our funds. Well, this is a comparison of the Magallanes European equity and the strategy compared with the value category in Europe, which exists. And we think that even though we're in this fame pond, it's not that favored by the market, we have got satisfactory returns. In the 5 years of been going, we've had around accumulated 11% return. But to say that 2.5% today is not a lot, in fact, in the short term, the returns are negative. So our fund has actually been able to achieve 8%. So this is a positive reading of the situation, and it makes us continue to be on the side of the market that hasn't done it as well as the entire market. We're still there at that position, and the fact that we're there, we haven't done a lot worse than the actual class itself. Well, what characteristics does this European fund have? Well, the 4 attributes that we think are the most representative, which are potential for revalue. We think it's got a potential of 73% for revalue, and that's a maximum when we calculate potential values. It's not 100% true because in December last year, with the drop, the incredible, well, when the markets plummeted, it was like the 27th and the 28th of December was when that happened. And a lot of them were in maximum levels when we set up Magallanes, well, I say 5 years ago now. The financial situation is one of the things that we really value. It wasn't that useful to have a very cheap company if on a financial level it's got a lot of commitments. 83% of our portfolio are companies that have got manageable debt or cash flows. What does it mean manageable? Well, they're able to pay off their debts, and it will not be detrimental to the company. It won't be a commitment that they will need to restructure. And the valuation, well, the multiple that we're looking according to cash flow is almost 10 times, and possibly be better if we compare this product to a bond or a product that has a return. So the cash flow return is about 11%. So we're buying a vehicle, an asset that is a sort of collection of companies, as Blanca explained at the beginning of this meeting today, and it's got a healthy financial situation. On the long term, we will be getting over 11% in returns. So this really means what we call these multiples. And when we talk about multiples, what we mean, well, first of all, you have to know what the actual word multiple means. And really, that's implicit returns. In this particular case, 11%. And there's another figure here that we really look about. And this is the percentage of commitment there are with the decision makers in that company. We need the alignment of interest. Almost 40%, i.e. 4 out of every 10 companies are family companies, and they're controlled by the management team, partners, industrial groups, which offers us some sort of guarantee. Not the fact that you're always going to make money in a family company, because when things going badly, well, we really think that the family would do as much as they can to make sure the company doesn't go down. Well, the potential and the level of investment, this is something new we've introduced to explain how coherent we are in the way we talk about things. Well, on the dark part is a level of investment in our portfolio, and progressively it's been going up while the markets have been going down. A year and a half ago now, our levels of investment were 85%. We didn't have a need to invest more, but we didn't do that because we didn't see any investment opportunities. There was no need to pay more than they were worth. But in the scale on the right, you can see the potential of our portfolios were 30s or 40%. And as far as the market in 2018 fell, our potential, or our portfolio potential, went up. It was the 20th of December 2018, almost 100%. And as the market went up, then we went up to our former levels in October, which are abnormally high based on what I've just said. And that was when our investment level went up. And that's where we started to buy more because obviously we had things. For example, our European fund, there had been a lot of falls. So this has been our activity, and our net level of investment is at 97. We've got 73 on the yellow line there, which is a potential versus a fundamental value. And so here you can see that how at the top or how above the assets that are part of our portfolio, how they're doing. When we measure it 5 years ago, the weighted value of our assets was still 32% lower than its maximum. But if we went back 10 years, it was still 35%. But it doesn't mean you always have to go to maximal levels. But what it means is that we haven't been buying at maximum levels. And so this says when you buy stock at maximum levels, it really think that could affect the future. This is an exercise that we wanted to do to break down the returns. So we think over these 4.5 years of our history in Europe, so we've got 38% of investment. So let's see what has contributed more or less. Let's analyze to see if the diversification that took place and if the different weightings that we did. Well, let's see if we went badly in one particular sector or not. But the real situation of the 10 best stocks with a return to 38%, 10 of the stocks explain or represent 25%. So this is 2/3 of the returns, which are explained by the top stocks. And in 66%, we have doubled in 6 out of 10. And so for one of our stocks doubles its value, it meant that we bought it cheap, and that was a case of microcrash. And as you can see all these different hypotheses. So it's got 100%. It means that we have very conservative, but there's still potential despite that. So what's behind all this? If half the stocks that we have in our portfolio that have done well, they have reached the objective price of our analysis, and that's when we sold it. And so if they've gone well over that, it means we've had a very conservative strategy, which is something that I like. What is very difficult and what is hard is to sell with capital gains that were well below our objectives. So that's the message I want to leave. So in our estimations of the prices of these stocks, because sometimes some went well beyond what we had predicted. And then the diversity of stocks. Well, we're not, as we say, the first company is oil. We're not saying we're the best people in oil companies. But what attracts me about our model that has been confirmed that it works is that the fact that we have a diversity of stocks, industries, etc., and we've made money. We've doubled, as I say, the number of oil companies like Aker and the electricity companies like Verbund and Juniper, the cement companies. We've got food distributing companies, door companies. So we've really got a diversity of different business. And the worst businesses, or should we say the worst performers, the 10 worst performers, explain, or more than explaining, they said they have had a 7% active of negative returns, and that represents just 16% of the funds. There are worse stocks. Our worst stocks have only had a -7% accumulated over the last 5 years, so we don't think this is very dramatic at all. So it means that we are not doing too badly with our investment criteria. And if we say if one single stock, or the worst possible stock, hasn't even got rid of 100 basis points, which is 0.9%. And so stocks like this, well, you can see Hornbach, Economy, Renault, Scorpio, TIM, and Shell Drilling. So what is the good thing about the right-hand side? The good thing, if it's negative, well, you have to see what's good about that. But let's give a positive reading to this. But basically, they're still alive, these positions, in our funds. And if it gives you some sort of idea, or so that you want to still continue to believe in the long term, on the left-hand side, almost all the stocks are no longer in our portfolio. And on the right-hand side, they didn't start being there, because normally when we buy these stocks, they start on the left-hand side with losses. It's a question of our time horizon. True, there is an era last year that we had a bad investment and we weren't able to recover it, so we executed it, we sold it. But anyway, Scorpio, we dedicated a lot of time to it, and we've had quite a few questions about that, but not as many as last time, because it seemed to be just a mono theme when we talked about our stocks. We lost over half of it. Today, we're close to actually making money out of Scorpio. So it's a very controversial position there. Well, the profile of our portfolio, this is something new that we have introduced. Possibly, well, if we go do a deep dive into this on a technical level, well, we can just say the investors, we bought cheaper companies, and we said there's one attribute which goes the EBITDA multiple. It's not the preferred way we do it, but everybody talks about EBITDA everywhere, so we had to use it too. You have to know the difference between a multiple of 10 times, 5 times, or 12 times. So we distributed our portfolio, which is the big blue circles, and all that makes up that, to see how expensive or cheap they are compared to the indexes. But we didn't just do that. We are not a management company that we just invest in companies that are cheap at a specific time. You know, we don't just look at that. No, we have to look at it for other reasons too. So, as I say, what we do, what we call the value trick. So we have these certain tricks or traps, and that we think, but why is it cheap? So we really have to study it, see there's a reason for that. So we have to see how profitable the business is. Is it a good business? Is it a bad business? What are the perspectives? It's a family company. So we put all this into a metric, which is the return on capital. Obviously, this is simplification, but so the higher the return of capital on the business, the higher the quality of the business itself. So a positive surprise, but I say, well, this is actually particularly the sort of businesses that we look for, but our portfolio isn't necessarily just cheaper, but not because we just bought any old stocks, not because, well, the world, I'm just going to say rubbish, but I don't mean that really. It's just that we're not just going to buy up companies and then we're going to, you know, sell them off. And no, we want companies that are of a certain quality and they offer certain returns. And a lot of the companies that we have are like that. So, as you say, we bought them cheaply and they offer returns that are more, you know, very acceptable compared to the market. Well, that's the message I want to transmit as the style of the stocks that we have. Well, here you can see the rotation, as Blanca said at the beginning, taking into account that we want to be transparent. And we're very clear about transparency. You can see it here. This is a specific example. We don't just say the amounts that we have made or lost. We put here the names of the companies, etc. And this is our activity. This is what we've done. Obviously, I'm not going to explain every single thing here, but the rotation means that what we change every year is around 50%. 10 or 50% of our portfolio is changed on an annual basis. As I said, I'm not going to talk about this again because this is in part of the information, our monthly information that we provide. They're the different positions. Now for our Iberian fund. Here we've repeated the same as Europa. The potential is 50%. It's never been that high. The companies are in financial situations that are very good. 2 out of every 3. Very little debt and good cash flows, which is 64, and the multiples for the 11%. As again, we say the control of the companies is in the hands of families, partners, and industrial groups. So it's exactly the same. We've got a maximum level of investment, which is 97%. Why? Because the potential for the revaluation, taking into account all the different part or the companies that are in that, so it's coherent to have this high level of investment. So then there's a leap forward at the end of 2017 because there was a political uncertainty in Spain, which meant that we got an opportunity to get stocks. Well, they were in Catalonia, Gas Natural, Miquel y Costa. These were opportunities that we got from the market, and they had short-term developments. And it was like as if they were complete maniacs. They were going up and down. But in that sort of environment, well, we bought and it went up. So that explains why we have that peak there. The same exercise for this fund. So what has contributed the most and why, and what's contributed the least and why? So you can see all the different stocks. And we say the 10 best stocks represent 32% accumulated, and the 75% of the performance of the returns in this fund come from 10 stocks. And in 4 out of 10 of those, we've doubled the value. And also we have, as I say, we have got the Baron de Ley, which Fluidra, we've got Lingotes Especiales, Naturgy, Colonial, or Iberpapel. Well, why do I say the 5 worst stocks? Well, because we've only got these 5 that have made losses. You know, we don't want to say there's 10 when there's only 5. And so they've got 4% of accumulated returns that were negative. And that takes 9% of our returns away. But what is important is that we've got 1.8%. We have a maximum loss, and that was the error that we committed last year in OHL. So you can't just have a cheap valuation. There has to be a reason why the company is cheap. The company is on that side, but we're convinced it's just a provisional thing like Meliá Hotels, Gestamp, Metrovacesa, CTT. And then you have the OHL. And I would like to say again, companies that they've been very successful on the right-hand side, we didn't start to buy them, and for minute one, we got spectacular returns. A lot of them, well, like I remember Fluidra was under €2. And we kept it at those levels for years. And Naturgy, well, Gas Natural has reconsidered in an elegant manner, of course, in lots of different forums. People say, hey, we made a mistake with Gas Natural, which is Naturgy. But as I say, when the valuation and everything accompanied it, well, we say we continued and we still bought Meliá, and we still bought Gestamp and Metrovacesa. You know, and we didn't get rid of them when they went down. Well, we still had the same amount invested. However, the price that the market offers is increasingly lower. But I don't really need to think about that anymore. But obviously, I'm simplifying a lot. So what are we doing now? We're buying more Gestamp, más Meliá, more Metrovacesa, CTT. But anyway, OHL we sold. And that was an error that we made. The profile of this portfolio is similar to the European one. There are companies that are more towards the right-hand side. Why? Because there's a lot of influence due to the Iberian market, and the index has got problems because it's got specific weight in banks and in important stocks. So I don't know how to say in these big stocks, well, these companies are not working well. So there are good reasons behind that you can think that there's their stocks at the moment are cheaper. Well, here you can see the rotation. In this case, it's less than 10%. So as I said, we've only, the rotation is only under this 10%. This is the annual rotation. Last year, we bought Metrovacesa and Inditex, you can see there. Unfortunately, OHL, but we also bought Gestamp. That was good, and that's what we did last year. And we've put this here just to be totally transparent. We sold 3 things. 1, because it didn't do too well, and 2, because there was a takeover bid, so we had no choice. So that's the story of the Iberian fund. You've got all the details here on the information we've given. You've got the main exposures, and if you can see, well, you've got Siemens, you've got NOPS, Gestamp, Inditex, and you've Siemens Gamesa. And then now I'm just going to spend a couple of moments, or maybe a bit more time actually, On the end, as we said, we've got the potential for revaluing of the microcaps is around 100%. It's 94%. It's never been that high in its history, but they've been going for 2 years, so we need to put that into context. So it's never been that high. When we have reviewed the stocks in the portfolio, we have to be particularly conservative so that the potentials didn't go beyond the 100%, but it's been very difficult. When it was high, it's high. So the question is, when? When is it going to revalue? But as I say, we have time and patience on our hands.
67% of the companies in microcaps are in a very good financial situation. Multiple is 8 and a 12% return and free cash flow. The stake, the average control stake is 66%, as I say, that we have in microcaps. Then, as I say, 66% is controlled by families, which of course is a guarantee. Its potential and level of investment, well, more than 100% with the terrific drop in December, and it has been really maintained then at 90%. Cheaper than the actual market, with that leaving to one side the return on microcap. Well, this is the portfolio. These are the companies that make it up. They're the cheapest ones in the market. Some of them are ridiculously cheap. Twice times the EBITDA. And that doesn't mean that their ROCE of 10%, they're 20% and 30%, which of course the ROCE is return on capital employed. And one will ask, why do these not rise? And then we take a look now at the actual level of transparency that we have, and we show you the situation. The rotation is very, very low. We don't need to bring on board more stocks because the ones that we have are so cheap. And this is the information that you people have, the main positions, and I'm going to finish now, but I would like to just analyze before I finish the situation and understand what's behind all the different stocks that we have in the micro caps. It's the first 5 positions of our fund. We have Ocero. They're Italian distributor of fresh fruits, tropical fruits, as I say, mainly banana and pineapple. Dole, Chiquita, Del Monte, Ocero pear as well. And they are leader in the Mediterranean. They're in the hands of Hernández here in Spain with the Ocero family. They control 40% of the company. This is a reality. They just distribute fruit. They're fruit retailers. They're not microchips or anything like that, or Hermes with their ties. No, it's something which is very tangible. And billion in sales, and this is the outcome, as you can see. 11.2% of free cash flow yield. And it's what is important for a company in 5 times the EBITDA. As I say, to talk about EBITDA, even though we're not great believers in EBITDA, but it's a language that we all understand, right? It's the valuation which is considered low. And 1.5 debt, 1.5 times the debt / EBITDA. Capitalization, which is adjusted with the free float, is 60 million euro. Well, these companies, these don't go up. They just don't go up. And when they do go up, when they rise, they do it very, very quickly and without letting you know, because there's an IPO, somebody discover them, everybody goes for them. And this is the response that I have. They're liquid companies. And of course, that's why we talk about the time horizon being at least 7 years and better 10, because otherwise it won't work. If we 2 years return, we're 30%. Well, we should be absolutely very aware of this. We should be shaking in our boots. I know. But I have to say that the returns we are offering there are pretty good. EDAG, the engineering group, as I say, it's a family company. the helmet company that owns 70%, 800 in sales, 11.6 FCF yield, 4/8 EBITDA, and 1.3 debt EBITDA, and plus 108% potential. We're not going to disagree with this. These companies are not covered by analysts. Well, they're not, and they don't have, as I say, hedging. There's no interest in hedging, so that's really good for us. But of course, you have to pay the toll. You have to suffer. And understand me, you have to suffer for some time until they bear fruit. And then you see the designs that they have, electronic designs for the new electric cars. Oh, we're all excited about the new electric cars, as you know. Nobody would doubt that. Well, this is a company which in theory and in reality can avail of the situation. They're 4.8 times the EBITDA. And then Avance Gas, and you see it's butane gas, liquid butane gas, 14 vessels that they have that transport this type of gas. It's a world leader, as I say. It's made up by Fredriksen, the famous operator, owner of the world of ships. 100 million in sales, 4 times EBITDA, 70% potential, 100 million in the market. Well, it's like Kurka. We'll leave it like that. The pharmaceutical company, Kdolsky, and they're leaders in Eastern Europe. It's a Slovenian company. And 28% is in the hands of the state. And they're only investors, as I say, from the region. And when we invested in them, they were very surprised. And these are investments in euro, as I say. We have it in Europe. 1.3 billion in sales, and you can see 5.2 times EBITDA, and 950 million euro, and its potential is 108%. And then Sol is a gas company, as I say, Sol SPA, like Braxa, Air Liquide. It's a leader, the absolute leader in Italy. It's a family company, 60% controlled by the actual family. 900 million in sales, 9.5% FCF, 6.6 times EBITDA, 100 million in capitalization. These are the main positions in our fund of the micro caps. And all the other companies that are there are very similar. Well, these have medical products, gases, electronic parts, and I think these items are going to be needed for the next 5 or 6 years, as I say. And as I say, I don't think they are going to be wiped out, and they're going to do everything possible so they won't be wiped out. They're not companies that were invented yesterday, right? And there's one of the companies, Camellia, which is about 2 centuries old. They have their history behind them. Their capitalization is very low, and that's why there's not so much interest in them, and there's no liquid tension, as you can see. But of course, when the market drops, as these type of companies can suffer. So that's why I say that the time horizon is so important. I know I've gone over my time, but I think we can take questions. And I'm going to have Otto and Diogo with me now. And Mercedes also, you know her from former years. And Arantxa, she's just come into the fold, actually. And within the investors department. So now all of them will take the floor. Thank you very much for your attention. Good afternoon. So we're going to take a look at the different questions that have come in on the application and also the cards that you've filled out. There are lots of questions, so we're going to group them according to the different subjects. And we'll see the level of interest in each one of them. If you consider that there's any subject that's pending, well, we would ask you, well, to meet up with us and we'll deal with them. We're going to talk about our investment philosophy. These are the questions relating to that. Well, there are 7 with regard to how the investment philosophy has evolved over time, and if you think that you being the owner of your own business has had a great influence. Well, our investment philosophy has not changed. I would say, thanks to the fact that it hasn't changed, we've hurled the results that we have. We continue to do the same as we did before. And we have made some mistakes, obviously. And we have observed some things that didn't work. But of course, when we go away from our philosophy, well, that's where when everything hasn't worked, as I say, paying too much for a stock hasn't worked. Everything that related to what we'll try out, well, we have learned that, as I say, structure is very, very important. And of course, we want to make the recoveries, as I say. Restructuring is what is, of course, is very difficult, but of course you'd never obtain a 20 or 30%. We've become more skeptical, I have to say. We question things more. Well, we have dealt with things in a more, showing more temperance, if you like. And become more skeptical, yes, definitely. There are lots of questions with regard to the prevalence of value. If value has died is the question. And also, if it's a good idea to combine value with other things in a portfolio. I think you dealt with this a lot in your presentation, but maybe you would like to mention it again. Yes, I did mention it, but I'll just give you some more information. If somebody asks if something has died, particularly in the stock exchange, right? Because people are showing that they're giving up ahead there. We have seen that the value strategy, and we see in the lake where nobody was actually fishing, well, has offered a lot, but well, very few things can go badly if you buy cheap assets, relatively cheap assets, and the financial situation is under control. Of course, you can make some mistakes, but passive management and active management is good. It's good that both exist due to different reasons. If it's more expensive, for example, active management, Blanca certainly explained this very well. That means that you make decisions in an active, conscious fashion, I should say, and we charge commissions that are above that of passive activity, because passive activity is replicating the indexes, right? So that's why we collect less commissions for that. Well, let's see how I can explain this to you. Let's think about football and rugby. It's a huge stadium with 50,000 people. Maybe football isn't or soccer isn't such a good idea. Well, you see there are cheerleaders, there are fans, people are dressed with short trousers and their football boots. You play for a certain time. And then there's rugby, they dress the same. They wear the same type of runners. And then They're completely different, aren't they? Rugby and soccer. But that's like active and passive activity. You have both. One doesn't replace the other. That's the important thing. But when you're playing a sport that you don't know what it is, that's the problem. In the case of Spain, you can take a look, make a very quick valuation. This weekend, there was an article talking about independent investors, right? I think it was in the Cinco Días specialized newspaper. And if we take a look at the figures, well, we've just come to 10 billion. How many assets are under management here in Spain? 200,000. So what does that amount represent? 5%. And what's in the middle there is a very significant part. It's investment funds, for example, which are distributed through financial channels. Very important part are sold as active management at a commission corresponding to active when they're really passive. But in line with what we were saying as well, there are lots that ask, we have to accept less than double-digit returns for the coming years. That's a very interesting question that has given us food for thought. We have been thinking about it, and it explains why we have dedicated a lot of time to the first part of our presentation. The returns that we are having, and we're talking about the fifth year, well, 4.5 years. We're talking about what, 8 and 9%. It's pretty good, as I say. To not lose money is an achievement. To make it grow, well, that's pretty good, right? But we have to put things into context because of the actual environment itself. 8 or 9%, what does that mean in an environment where there's almost no inflation, and the other alternatives without risk and, of course, without a return, obviously? Well, that doesn't exist because you have to pay for it in the deposit and the treasury notes. What stock has 8 or 9%, but in an environment, well, the alternative is without risk, if you like, according to the old standards, and that's 0. And we've been thinking about that and looking at it in great detail. And when we were with Peter Lynch and with Blanca, Peter Lynch obtained almost 30% on an annual basis. I don't know if we'll be able to repeat that. That was 13 years ago. But when he analyzed the actual environment, the end of the 70s, the 80s, for example, Peter Lynch, of course, is his point of reference for us. What other types of returns existed then? We're talking about double-digit because the inflation rate was very high. We have to put things in context with regard to the alternatives that we have. This is a line of business that we have to explain very clearly. It's 8 or 9%. Well, we're not going to lie on our laurels, of course. We have to see what are the alternatives out there and what can be obtained from them. Well, lots of questions with regard to the commissions, if we should bring them down, if we should set up different classes, a lower class, for example, related to permanence. And there's great interest with regard to the alignment of management. And for passive activity, should we be charging commissions? I don't know, Blanca, if you'd like to say something about this subject. Well, the commissions, right. We wanted to have adjusted commissions. I'm very critical with regard to the commissions in our sector. And we had to make a decision, though, with regard to the different classes, because there was a question with regard to different classes for commissions. We decided that there wouldn't be a minimum, nor €500 nor €1,000. There was no minimum either in the contributions. We receive €10 for example. And that's what we would call the retail, and it's at 165. And I think it's amongst the average, and even a bit lower than the average, and for all the young people as well. And the tiers, when you go up the tiers, well, they're not much higher. 95 there, I think, which is quite below. When we talk also about controlled size and activity, I think we should, well, you can lower when you have terrific volumes, I should say, but we don't want to have terrific volumes. As I say, we have low commissions for those who have long-term permanence, and not all the funds have it because we don't believe in the repayments. The funds are liquid, as I say, so we offer freedom there to invest. Yes, and of course, we ourselves represent 20% of all our investments.
Well, you've talked about the micro caps. There's lots of questions about micro caps. Some make a reference to them as how do you distribute the time between the funds? How much time do you dedicate to the Eurocaps fund? And there's questions about liquidity, diversification of the micro caps. Well, let me go straight to the point about the time that we distribute, well, the team's time spent on that with the micro caps is, well, we spend 100% when we have to review the micro caps. Well, the reviews, or as you say, when we have a quarterly results review and we have a model, and what we do is we update all the different stocks. When they have ideas, they're analyzed from the very beginning to the end. And the microcaps have something that's very special about that because they are obviously related to the time horizon. And in the presentation, I said about the rotation. Once we've set up the portfolio, and the reason for having these microcaps, and it's a good idea to remember this, as a fruit of the investment process in our funds, in the European fund and the Iberian fund, the results of the investments where we have the companies that we started, they're ones that were very liquid, but you couldn't invest in them. They had no cover. We couldn't introduce the standard funds or the ones that we'd had at that time because they had a specific, size. So then we came up with the idea a couple of years ago of having this microcap and to packet them into a vehicle with a limitation. So we said, well, they can't be of more than 100 million. Because otherwise it loses the fun out of it. Because, as we said, otherwise they would be put into the Iberian fund. But all the knowledge and the accumulated knowledge that we put into packages, and then we had the profile of the maturity of, we said, the 7 to 10 year period, as we said. So it means that we don't have a need to keep, changing our ideas every year. However, when you have to review a company that we have in our portfolio, well, we spend as much time on it as we need to. And I said we have time because the team, that's what we work on. That's all we do. We analyze companies and we publish information on a quarterly basis. So, that's what we do, review. Time, dedication. What was the other question? Liquidity. Well, liquidity is very important because that explains the performance of, for example, why are companies cheap? Well, sometimes because they've got a lack of liquidity. So this is why the stock price goes down. And so maybe this means, companies that aren't liquid, well, people are not interested in investing in them. So we look at the daily liquidity, as I said. Our idea is to remain for 5 years, and it's not by chance that we have liquidity levels in a fund. We're very cautious, 10%, and I feel comfortable because we're talking about a fund that has a potential of 94. What would I change in the fund's potential? So instead of being 90% investment, we had 100%. Well, We have 1.24 as against a 105 potential. Well, the difference when we talk about doubling, we're talking about the fact that you have got 10% liquidity. But what could happen? Well, that explains this liquidity issue. So the liquidity of the fund and the fact that the companies in that fund are not liquid. There's another question about microcap companies themselves. The most common ones are Italian way brands. Would you change that? Or some of the others? I don't know if it means you've got to have to go into too much detail. Who's going to speak about that? Wow, Otto, do you want to talk about that? You're going to talk about Camellia. Well, as you already said, it's a company that has got 130 years. It's been going strong. It's a British company. It's one of the leaders in tea, high-quality tea production, 35,000 hectares of land in countries like Bangladesh, India, Kenya. And apart from tea, they also produce avocados, different dried fruits. And apart from the production of tea, they've got certain engineering products, and they also their core business is tea, as I've said. We want to see, or we looked at the fact that this company's got a market cap of 290 million, and they've got net cash flow of 110 million, so it's over 30% of their. So we're talking about the valuation. They are listed with a 30% discount as compared to its book value. And if we carried out a conservative valuation, and we're just looking about the agricultural tea business, so there's 10 times the benefit. So the other businesses don't basically offer a lot. So that's the Camellia situation. Safe Style, Italian wine brands. Well, Safe Style is the leader of manufacturers of doors and windows in the UK. We bought Safe Style at the end of 2007. Why? Because after a profit warning, their stock price went down. We started to study the company, and we analyzed it, and we thought that it was companies that had a high volume of sales in pounds. It's a lead, or it was the leader. Well, it's still actually a market leader in the UK. They had 10% operative margins, and we like that sort of stocks. And they had net cash. But what happened? What happened in the year 2018? Well, something that after so many years, each year you learn something new. With Safe Style, we've learned something new. The ex-founder of Safe Style, Mr. Mishram, sold his shares at £1 because he was angry. He was cross. Because then it went up to £3 or more. So he founded his own company. And he put a name very similar to Safe Style. So he called it Safe Case. And it was very similar to Safe Style. And the prices were a lot cheaper. In fact, even though he lost money. And the worst thing was he, stole staff. So Safe Style suffered tremendously during the year 2018. I think sales went down by 20%. Market share went from 11% to 8%. Safe Style changed their management because they didn't see that what was going to happen, what the ex-founder was going to do. And then, obviously, they took him to court. And we looked at Safe Case, and we actually looked that it was using the same cases. So he confused the logos, and it was very confusing for customers and consumers of Safe Style. So what happened? In 2018, November, they came to a settlement. Mr. Mishra came to an agreement with Safe Style. He closed safe case. He also lost lots of money, and they came to an agreement of a non-competition agreement for 5 years between Mr. Mishra and SafeStyle, in exchange for the fact that this man could take 5% of SafeStyle and 2 million euros in the year 2020. So we think that SafeStyle is going to improve. So and when we looked at the last quarter's results, it seems that gradually things are getting back to normal. So SafeStyle is getting back to normal. So one of our latest valuations, I said we're not particularly aggressive, but this is a stock that we think could double in price. What was the other one? Italian wine brands? Well, this other company was quite disappointing because I'm Austrian, so we went to Budapest. We saw the company. They are the leader in the transport sector in Europe. They have about 4,500 lorries. We saw their competitive advantage. They had 4,500 lorries. So it was economy of scale. There were lots of transporters that could have the capacity of Sony or Samsung in the good times. But what happened? The costs in the transport sector went right up, and also fuel went up, but also they had labor issues. They didn't have enough lorry drivers. And not just in Germany and in Italy, but also in countries like Hungary, Poland, and the Czech Republic. And also the transit costs. So the costs went right up. And another reason was there was certain weakness in their second most important market went down because of Brexit. And the management didn't really know how to deal with these problems. The CEO left. Now there's a new CEO who came from DHL Express. So he seems to be dealing with the problems. He seems to be cutting off all the what was making losses and getting more profitable routes. And he's also cutting back the number of new lorries. So he's going to have less lorries. But we really think that because of the somewhat, de-acceleration of the economy, we think there'll be less pressures. And we actually think that it's cheap at the moment, under 100. What about Italian wine brands? Italian wine brands is one of the companies, as Otto says, that's one of the big wine companies in Italy. It's a listed company. They produce about, I think, 50 million bottles a year, and it's direct sales done by the phone or by email. They've also got an online business. They have stable sales. And then they have wholesale business, which is doing very well. They've got a very good contract for supplying. So it means that the sales are going up a lot. And the CEO and the founder of the company has got over 10% of the shares. So the price is currently cheaper. It's 5 times the EBITDA. It's like 30% of free cash flow yield, very little debt. So we really think there's great potential there of even 80%. So we're very happy with that company. Just a couple of thoughts about that. I think we've talked about 10 stocks or the micro caps. Well, the time we dedicate to that. It's like 20%. We can do 20, the microcaps, we spend like 20% of the time on that, with a level of being convinced that when we listen to this, and it's like a therapy that we do, we go run through them all when we've got doubts or the things not doing too well, then we review our investment reasons. And so we looked at 5 stocks to confirm if we were doing correctly. We always try and do that periodically to check that things are okay. People are interested of where you invest your financial equity. As Magallanes, how can we know? Or the proportion in the Iberian or the European fund or the microcaps, where do you actually invest the money? And if we buy and sell the funds, is there sufficient transparency about all these things? I don't know if Blanca, you want to start, or who wants to take the floor? People told me not to be discreet, to be open. Well, yes, each month we have to say if we're, going in or leaving a fund. That's why we're very transparent, as we said. And apart from that, with regard to remuneration, we have a bonus, a 5-year bonus, because we talk about long-term work, and that will just be because of the participation in the funds. We have a code of ethics, and the entire team has to have money in funds. And I've said several times, about 15 or 20% of the funds belong to us, the founders, and personally, Blanca, Hernández. What I'm saying is all my liquid amount is in the stock exchange, and everything I have in funds is in the Magallanes funds. I obviously buy and sell, but I've only sold when I lose confidence in the manager, and also when I have to pay taxes, and also wanted to make another type of investment, and I didn't want to become indebted, so that's why I've sold. Well, as you know, I've been working for 20 years managing a family of, my family, uncles, nieces and nephews, etc., and I have diversification there, but I think 15-20% in the Magallanes funds, and everybody knows my investment I have with Paco, and my proportion at Magallanes is the same as everyone. I haven't changed at all. 80% Europe, 20% Iberia, 3 million in the microcaps, and 3 million in Magallanes Impacto. Well, it's the same. We invest, and we repeat this every year. In my case, it's 100% in the stock exchanges via the funds. And as Blanca has said, if I lose sort of trust in the manager, well, that's bad news. But apart from that, everything's pretty much the same. Oh, there's an exception. A few shares I have in Berkshire Hathaway, which I bought. Well, I keep those shares. But that's just a bit of a joke. But the 100% of my finance and stock exchange money is in Magallanes. Well, percentage and indiscretion, as we've said earlier. I can say it, but what I don't want, if the fact that I tell you that, I don't want you to consider this as to be sort of like advice. So if there are questions that are repeated and people really want to actually know, well, I would say that half of it is in Europe, and there's like a half and half again between Iberian and microcaps. In my case, I might invest in the stock exchange and 100, and also which is via the Magallanes funds. How is it distributed? 40% in Europe, 45% in microcaps, and 10-15% in the Iberian fund. My case, I obviously have a very important part in our funds, which is how it has to be. 60% would be Europe, 30% in Spain, and I think he said 3% in 10% in microcaps. There's lots of questions. After 2018, well, you, what about all of you? No, that was a joke, because we're not doing well for time. There are a lot of questions related to the markets. After 2018, the performance of the markets in 2018, the questions are there still opportunities out there? Is it difficult or easy to find cheap companies, undervalued ones? Do we have sufficient ammunition? Because we say we've got 3% liquidity in the funds. And there's other questions related to if you've got liquidity, is there more potential of things? For example, if you want to buy something with great potential, but we don't have enough liquidity in the fund, do you actually sell something off to buy it? Can you explain that? Well, lots of different questions, but no, we don't normally work like that. And normally because the natural pace of each company that we have in the portfolio, some mature earlier than others. And some we do sell, and then we buy others. So if it's an extreme case and we see a great opportunity, which happens once every 10 years, well, we could sell a company, whether it's done well or maybe, or sometimes we'll admit there's been an error. We don't have a specific dogma, an extreme dogma in this respect, but we don't normally do it like that. But what's interesting, well, it is, everything's interesting, obviously, but what's interesting in this particular way, if there's any dry powder, what will we do? Well, that's related with the fact that we don't make decisions according to whether we think their funds are going to go down or not. We just see how cheap the companies are within this famous lake where we're fishing, and to see how many companies are there and market values. And we have to see what other opportunities in the market. And this has happened, I should think, quite a lot over the last few months. We've got investment levels as they are because we have seen there's been lots of opportunities and cheap opportunities. But up until now, you probably hadn't seen it. But no, not in that magnitude or that amount that has happened since last November. We hadn't seen that before in Magallanes and for a long time. So this means that we have to increase because we're not going to leverage the fund. So if the market plunges again, then they will be cheaper, and then we could increase whatever we want to increase. Could you explain what the main risks are in our portfolios? Are they common to each fund, or does each one have its own peculiarity?
The common risk, and this of course is very obvious, the risk of the market, well, the portfolio collection of enterprises that are listed companies. Well, of course, we're not immune to swings. So we have to make a distinction between the three strategies. There's one just for exports, everything that's related to noise with regard to tariff war, etc., that we're seeing this week. Well, that's more vulnerable, but everything that is related to world trade is more vulnerable. Iberia here in Spain, political risk, for example, what we've seen lately in the last 3 years will particularly affect that. The micro-cap portfolio, what specific risk does it have? Well, liquidity. So these risks shouldn't frighten us, but we should be alert, as I say, saying, well, I think this is going to happen. Well, what happens here is it creates opportunities. And we have to understand, thanks to all the noise there was at the end of the last year with the tariff war, what came from China, noise from China, the monetary situation, if they were going to change the interest rates, etc. Well, thanks to all of that noise, well, we were able to increase our portfolio. Well, it's a currency, if you like, and it has a risk and on one side, an opportunity on the other. So, and we want to make sure that it's an opportunity, obviously. There are a lot of questions as well with the results from the elections, the political risk for the Iberian fund. And we're asked also about business generation and now what was the Iberian fund? Is it more international? Well, yes, the noise. Well, political situation. And I talked about soccer as well, and we could mention both. But this is not new. This is nothing new. You've heard us comment before that the time horizon of our investments and the companies that are with us and the managers that are in charge of those go beyond the actual mandate of the politician and his term of office. Fortunately, I'm not going off on a tangent here, but almost. So let's avail of the sporadic noise we hear because of elections or political tension. They've always existed and they're going to continue to exist, right? Nature of politics is to live in a situation of instability, and this generates opportunities. And what allows us to avail of these opportunities is our time horizon and our investors. That's why I've insisted so much in the presentation that we go beyond all of this. Our investments have gone beyond all of this. Yes, how Iberian are the Iberian investments? 23% exposure here in Spain, and of the sales, yes, 23%. There are lots of questions with regard to the team, taking a look at the number of enterprises, etc., that are out there, and how you have the time to analyze all the different funds, and is the current size of the company sustainable? Well, yes, this is interesting, and of course, I think as time goes by, well, this is our 5th year, and the team is what it is. All the ones that were there at the beginning are still. We're still together, all of us. We prefer to continue to manage portfolios and not manage people. I know there are lots of big companies with a terrific wealth but a terrific amount of people, and of course then the results were not great. I don't think there's any correlation between the number of people on a team and the actual returns obtained from the investments. I've lived this before, and I said we're a niche. We don't aspire to have all types of vehicles. No, we have European stocks and we segment them according to the geography, but that's the way things are. And I want to continue managing portfolios and not manage different teams. And what we did last year in 2018, and help me with this data, please. 350 meetings we had, right? 3 people, 350 meetings. That we don't stop. Yes, but that's what we do. That's our work. There's a seminar today we hold, for example, and we meet up with, 25 companies. In 3 days, for example, we went to Norway and we met up with so many companies because that's what we do. And we're here to account to you. We have at least one meeting per day. And then we have MiFi 2, which reduces the number of analysis and the quality, and it forgets about a lot of small companies, and then it leaves companies out there, orphans, and that's what we're interested in. We've analyzed more than 50 companies this year. Of the 115, we have rotated 10, and for 10, we have studied 50. You have to put things into context. I'm not saying what model is good and what model isn't good, but what we do, coverage that we have, I think is pretty good. It would be better to have somebody else. Yes, and it's possible. Yes, it's not easy though. It's not related to having 20 languages, 5 university degrees, etc. Yeah, they're out there. Not a lot, but Ottos y Diogos, there aren't so many. There's 12. There's 12, that's it. But you understand what I'm trying to say, right? When you take the initiative and if there is no imperious need, well, that's fine. But you've got to weigh up what you're bringing into the fold. Just because they have 3 degrees and they speak I don't know how many languages, that's not enough. They have to be very enthusiastic about what they're doing. They have to be ethical above all. But as I say, I want to continue managing the portfolios that we have here, 115 that we have on our books, and to exchange this for managing people. With MiFID II, how have things changed? What enterprises have you analyzed recently, could you tell us, and that you have left to one side, and the time from the time that you decide or examine a company and then you bring it on board. Now, I would just like to sum up very quickly, but what we want to do is improve the transparency of the financial market. That's what was the idea of the MiFID. But we're seeing the result is opposite, not so much with transparency, but there's an interesting report in financial report, companies without coverage, as I say. It's gone up from 24 to 25%. It has increased, and that's what this has brought about, the MiFID II has brought about. I said this during the micro cap presentation. This is a business, whether we like it or not. Well, we like it, obviously, because it's our business. You don't earn a lot of money selling stocks of companies that have ridiculous market capitalization. That makes sense, right? So we're not going to cover this company because it's not of interest to us. And that's good for us because that's where we find opportunities. This has been good for us, and we haven't reduced the pace of our work. As we said before, we've analyzed more companies than ever, and we've had more meetings than ever because our business model is based on the elaboration of our own analysis. We've seen lots of sectors yet, and we've discarded some stocks, as I say. Let's talk about sectors. We say we've discarded stocks, and then we go and buy them, but we can better not say that. We could talk about the different sectors, the sectors that we have discarded. Telecoms, for example. A company that we have chemical companies as well because of the terrific drop in that sector. European components as well. There's an awful lot of work to do there. It's work, it's ours. And the pipeline of ideas, as I say, we have examined like 200 companies. And when these companies reach our target price, well, we have analyzed, we've done all the analysis on them, so it will be far easier for us to bring them into the fold. Now we have to finish with these questions. There are items related to the different stocks. Are you going to bring banks into your portfolios? No. No, we're not. No. No. Can you tell us a little bit more? Yeah, well, we haven't got much time, but I'll say no. We're not going into that sector. We prefer people like Hestamp. far more than banks, particularly because of the people that are in charge of it. Yes, of course, there are so many interests at stake, and that's why banks are questionable. The banking sector, as I say, we decided that we wouldn't invest there. And as I said, 5 years ago, we mentioned that, and we thought they were not companies to invest in. And in Magallanes, we are flexible. We don't cross out any beforehand. We look for companies where we can earn money. Well, we've seen one company that, as I say, disappeared. They multiplied by 3 and then disappeared. In other words, they just went bankrupt. Yeah. So, yeah, we're just not setting up beautiful offices with LED lamps and whatnot. Well, there are lots of competitors. We are in investment funds. That's our business up until now. And of course, the distribution is the main part. There are some payment systems that we're not interested in, as I say. And there are some banks, of course, that for currency without any costs. I imagine the banks want to be out there because otherwise they're going to disappear. But as I say, their background, as I say, their personnel, their office, branch offices, etc. In other words, their structure was set up for another era, which I don't think is going to come back. So it's a very complicated business. We saw yesterday, CaixaBank, I don't know how many more offices they were going to close down. The returns that you can obtain with them is lesser. It's a sector that has lots of challenges, but everything has a certain value. And we feel that we're not there yet. The margin isn't sufficient for us, and I would finish by saying we need an increase in the interest rate so that the financial services work. We had a threat that they were going to rise at the end of last year, and one of the banks had terrific problems. One of the banks that's not so big had, as I say, had great problems because the banks today are not only in their traditional business, and that what we find strange, but it's because of the bond portfolios that they have, right? And as I say, their bond portfolio explains things more than their P and L. And of course, their main business of lending and etc. But having said all that, I would say if we do find something attractive out there, we'll think about it.
Well, Portugal goes to Portugal last year. Well, we talked about it here in our last Investors Day, and it's a company that hasn't done well. We've had problems with the management team, but we've seen a change in the company. They changed their CFO, and they've got a transformation plan. And they were changing their cost structure. So they've done well. They've overcome their objectives. It's a plan to 2018 to 2020, and they're doing well. They have bought a loan portfolio that meant that the bank will now start to earn money today, as of today. The share prices continue to drop, but it's mainly because of the cycle. If the part of the cycle in the industry, there's been a lot of contagion. So from organic standpoint, things are doing well. The perspectives for this year of sales and EBITDA are going to go up because they've been going down for several years. So, and that is independent to the acquisition they made. So I think the value of the company will be improved. Do you want to talk about Inditex? Very briefly. We bought Inditex last year. It was lower the price than it was there, but obviously the markets have had very difficult years. For us, Inditex has always been a good business, but it's not always been a good investment. For the founder of the company from the very beginning, it's always been a good company and a good investment. He put up the capital, and it's been multiplied by lots of different times. But there have been certain moments when if you actually bought Inditex, you had to pay, I told it was high, and you didn't always get such a good return. Last year we got an opportunity because it went from almost 30 a share to 20-something because of the cycle. And then it made sense to buy it because the quality of the business is not questionable at all. We had been previous investors. We know the company well. We know a lot about the company. The business, that is, obviously, they have their own brand, and they have gross margin of about 60%. Well, I don't really know how many brands they have these days, but anyway, margin. Operating margin and EBITDA is around 20%. What business have that margins in the distribution business and also their online sales? I think it now represents $3 billion with margins that they don't publish, but it doesn't dilute the actual Inditex ordinary margin. Well, who can they compare with? ASOS, which I think get 5 or 6%. So we've always said that Inditex is a technological company that sells clothes. Well, it now sells cups, glasses, candles, whatever they put up, whatever they decide to sell, they sell it. And they've got good technology, and they've got very quick reactions. They have very low stocks. It's a great retail distributor. And that's a really good competitive advantage. They don't have a risk of inventories. It could have the risk of a retail distributor, but they don't have low capital. They have like negative. Amazon has that too, and H&M. People think it's similar, but it's different. They have almost 20% of their capital. It's yet another retailer. It's a good retailer, but they don't have that competitive advantage that Inditex has. So we're patient. It went down to 20, but I've said in the past the share price has been over 35. Financially, it cannot go bankrupt. So what this founder has done, people criticize him or whatever. They say, how can you even question what Aránguez has done? It will never, ever go bankrupt because they have no debt. It will be almost impossible to go bankrupt. But what we just need is time for the price to go up. Okay, thank you very much. There are questions, but I'm afraid we can't go on any longer. So now, as Aránguez said, when we've finished this, we will all be available to you. So thank you very much. We'll end this session and now go on to the next one.
Thank you very much to all of you for coming here today. And the investment day in Barcelona will be on the 28th of May. Thank you very much.